Today we're about to begin topic number 7. First of all, if you remember way back to the beginning of the course, we started with financial statements. You see one on your screen here, a very simple income statement. What we're going to do in topic 7 is a little similar to what we did in topic 6. If you remember, I began topic 6 with an introduction that said that the salary expense transaction where we debited salary expense and credited cash for the same amount was a very simplified version of what really happens with payroll. After that, we had a number of different complications with payroll. We talked about payroll deductions, how to record those and post those. We talked about different kinds of taxes. We talked about unemployment taxes. So it got a bit more complicated than we looked at way back at the beginning of the course. This is similar to what we will see in topic 7. If we look at the income statement, we're kind of cycling back to where we started. We've done a number of things with the field of accounting and talked about journalizing and posting to the ledger. And now we're going to begin getting that information from the books of the business into the financial statements. We'll come kind of full circle here. So we're looking at the income statement here, and I want to point out a couple of things. We see that this is a very simple statement showing revenue and expenses. If you take total sales, you subtract expenses, total expenses, you get a net income. Now, what we don't see here are some things that we see on other statements. For example, inventory. If you remember, we had another statement called the balance sheet, and one of the assets on the balance sheet was inventory. These are things that we purchase or things that we make that we're going to sell eventually. We're going to come back to that somehow and see how that fits into what we see here. What I'm telling you is that similar to the salary expense transaction, the sales that we see on this income statement is a very simplified version. So we're going to, unfortunately for you, complicate it just a bit because we're going to make it a little bit more realistic than you see here. First of all, looking at the income statement on your screen, this is the XYZ company for the month of January 2017. We will assume that the XYZ company is similar to a store like a grocery store in that they purchase things to sell. They don't manufacture things. They purchase something and then they sell it. A grocery store purchases the food items, the vegetables, the fruit, the canned goods, the cereal, the milk, all of the things that they sell. They purchase from a wholesaler of some kind or perhaps directly from the farmer. But they purchase an item for a certain amount and then they sell it. So that's the kind of company we're talking about here. The first thing we will look at on this income statement will be the revenue part. And this looks like we made total sales of 10,000, and then we subtract the expenses from that. In the real world, we need more information than simply that. If this is a grocery store, we may have made sales of $10,000, but what it doesn't show is how much those food items cost the grocery store. So if we sell fruit, vegetables, cereal, milk, whatever it might be, there's a cost to all those things, and that's not shown on the income statement. All of those things that I mentioned for a grocery store would be its inventory, and somehow we have to account for that inventory and make sense of it concerning the revenue. So if you're the owner of this grocery store, you want more information than simply total sales. That doesn't tell you enough. Is this a good amount? Is it low? Is it high? And how does it relate to the money that we spent for the inventory that we had to sell? If we bought all of our food and all of our vegetables, fruit, milk, all of that, and that total amount cost $12,000, then we're in trouble here. So we need to factor that in as well. And that's what topic 7 will get into. So what I want you to do is to take a look at the following video. This gives a very simple but a pretty good explanation of something called cost of goods sold. It incorporates the inventory and it incorporates a concept called cost of goods sold. So that relates directly to our grocery store here. We need to know what is the cost that we spent for the things that we sold. It doesn't matter what kind of store it is, there's still a cost involved. If this would be a manufacturing company, then there's still a cost. If you manufactured, for example, an automobile, if you're a corporation building cars and selling cars, it costs you some money to build those cars. And so the total sales is not the total answer. So that's what topic 7 will get into. At this point, I want you to go back to your course page, take a look at the video. There are some questions to answer following the video, and then we will go from there. So you've got 2 parts today. This video right now does not have questions with it, but as I said, go back to the course page, watch the next video, and answer those questions.